Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media, generally related to commodities, financial topics, and or wealth building. And I'll interject my financial opinions as we go through it. And yeah, let's see what people are talking about on social media. If you want to follow me at @Finance, and if you want to join our community, finding-value.com, that's where I dive deeper into potential opportunities in the stock market, in individual sectors, individual companies like that. We still have our coupon code LEAP, LEAP, going on if you're interested in joining. We have a Sunday question and answer session coming up at 5 p.m. This weekend. So Michael says, just in case someone was wondering why most people have this strange feeling that they are becoming poorer each month after paying their bills. He says, sorry, folks, it's only going to get worse from here on. Inflation is the only way out for excessive debt. And then I was looking at these values here. It says cumulative price change of inflation components and wages since January 2021. Um, well, I mean, 2020, I don't think gas prices are a fair measuring stick because they were pretty low back then. But I know for a fact that gas is not up 49% for me. I just paid gas at $2.88 a gallon. And I think in 2020 or 2021, they say January of 2021, um, I think gas was in like it was $2 and something cents back then, for me at least. So it's 88 cents over $2, and that's not quite 50%, but I think that's a little bit lower for me. Utilities, I would say from that point forward, my utility bill's almost the same. I don't see a huge increase in utilities for me, maybe 10% at best. But what I do see is my food price. There's no way it's 21% higher. I think my food price is like, if I were to make a guess, I would say it's at least 50% higher for food. The packages have gotten smaller and the prices have gone way up. So, of the things that I see here, my biggest impact's been food. And the pricing and the size of the packages, I would say at least 50% more. At least. These other ones aren't as bad for me. Urine says, hopefully that's pronounced his name. For U.S. Treasuries, the lack of a positive term premium in an era of fiscal dominance doesn't make much sense. If inflation is to remain sticky in the deglobalized world, amid deficits and a Fed that isn't willing to subsidize the Treasury's endless supply of debt, the term premium may well rise. And basically, we've got this 40-year decline in interest rates. This is the US long bond. These are interest rate yields. Decline, decline, decline. We hit a bottom here. That is a shoulder, a head, and a shoulder bottom pattern. And we're starting to work our way on up. And I don't see any pattern or topping pattern that is present. So it looks like to me that we could go higher over the longer term, higher highs, higher lows, with higher rates of inflation. Much like it was in the 30s to 40s to 50s to 60s to 70s, all the way to the peak of 1980. Some people say, oh, we're going to have a 40-year increase in interest rates. I don't think that will necessarily be the case. I think that the rate hikes or rates going up are going to go up faster than that. I don't think we're going to make it 40 years, guys. That's my guess. I think interest rates will go up, and I think that we are going to get maybe a potential debt problem on our hands at some point, and that's when interest rates really go up. Rolling down the Kobayashi letter, it says oil prices are now down nearly 10% from their highs as fears over higher interest rate policy spread. With markets now seeing less than two rate cuts in 2024, demand outlook is questionable. This has put oil prices at their lowest level since March 28th. However, prices are still up more than 15% from the February 24 lows. The case for a soft landing seems to be losing hope. I don't know if I actually agree with this, guys. Demand continues to go up. And yes, they are using oil prices to drive a narrative. So since oil prices have fallen here in the short term, they are making up a narrative to follow the price movement. I think that oil demand continues to go up. I think that inventory levels are at a price that is probably slightly below $85 a barrel, given the commercial inventory levels. So the prices have pulled back to where the commercial inventory levels are for a fair value. I also think that going into the summer that we're going to have inventory draws and prices will go back up again. And of course, they'll change the narrative to fit whatever the prices are, in my opinion. Patrick says, stay very clear when you observe these three clues. Peak volume plus an unwind equals a check, like we've got it, it's present. Peak momentum plus unwind equals a check, so that's also occurred. And peak price plus unwind is also a check. So this is MicroStrategy and their daily log chart. Let me zoom this back in here, guys. 1 second. There we go. And what he's talking about is you can see a decline in the distance percent from the SMA. We have big volume and then it's declining. And now we're starting to get a decline in price. So observe price, volume, and momentum, which is all in check for a potential decline for MicroStrategy's stock price. So we are seeing technology stocks kind of roll over, some of them, and Bitcoin's getting a little bit weak as well. And I know he's leveraged to the hilt, this company with Bitcoin. Michael Saylor, that is. It says, just in, the IMF has warned the U.S. that its massive fiscal deficits have stoked inflation and pose significant risks for the global economy per FT. Yeah, I think so. Gold silver, as Mike Maloney explains, this cup and handle projects silver reaching not just $100, but likely mid to high triple digits, while quadruple digits may be a stretch. All signs point to silver finally having its day in the sun. That's that big 50-year plus cup and handle pattern that we've broken here recently. And that could be a big move to the upside. What would drive silver and gold to ludicrous levels? If we zoom back up, the US that has massive fiscal deficits and this interest rate breaking to the upside, they are all correlated. They're all signaling the same thing. The interest rates breaking this 40-year downtrend is signaling that we have a deficit problem. The deficit problem is stoking inflation and increasing interest rates, which then paints this big picture over all these years of a deficit problem. And the deficit problem is pushing gold and silver to new higher highs and created these big patterns. It's all interconnected. It's all baked into the cake here, guys. All of these charts are signaling the same thing. And that is that we have a debt problem. And this debt problem will be so big and it will be so far reaching for the people who live in America and people who transact in dollars, I think, or even just other currencies in general. It's going to impact everything. And it will probably result in war. And that's why war is starting, because they need something to blame. They need to say, oh, the war caused the inflation. Oh, it caused this. A bunch of BS, guys. A bunch of BS. All of it's been baked into the cake. The herd knows about this and has painted the picture here recently. It says an investor needs to do very few things right as long as he avoids big mistakes. Big mistakes is buying on emotional buying at tops. And if you're really good at being a good investor, you buy things that are undervalued, very cheap and early, and then you do nothing. You do absolutely nothing. You don't let the market volatility impact your emotions, and eventually you become an emotional investor. You got to get rid of the emotional investing. Don't be scared by price movements and volatility in the short term. Get a bigger picture strategy, knock it out, stick to the strategy. Patrick Karam says the third greatest rotation in the last 50 years. It's close to happening once again. And these are the big rotations, and he's just using JP Morgan priced in gold. So basically, it's the banking sector priced in gold. And when gold outperforms in a lot of these market conditions, that is when you get these big commodity bull market moves. 1970, that occurred, a big change in the market conditions in 70, where commodities and gold outperformed. It occurred in 1999. And again, these are the bottoms of also the commodity to stock ratio. We also got a bottom in the commodity stock ratio in about 2020, which is in here. But in 2022, that's got what he's written here of the entire pattern rolling over. And we're about to break this last trend line to the downside. You can see that we're getting a lot of big red candlesticks, which is distribution and selling pressure. We can also see that JP Morgan's CEO is selling his shares in Max. He knows this is coming. He knows exactly what we're looking at, this chart. And this chart is also a function of interest rates going up, a fiscal debt problem, and money rotation into these assets, gold, silver, and all the stuff that we've been watching. It's all interconnected. None of it is moving at a they are all interconnected and correlated. Nothing is moving at its own pace or rhythm or beat. It's all interconnected. It's all in the same pace. It's all in the same beat, and it is all signaling the same thing. All of these. The interest rates breaking that downtrend line, that 40-year downtrend line that we looked at the first picture, it's not a happenstance. It's because of exactly these things that are occurring here. They're all interconnected. We're all nodes interconnected. It says, wait, Mr. Housing Bubble Crash 2.0 and 3.0 is back. Can I read another of your great housing bubble crash threads again? They were awesome as the price continues higher. Now, a lot of people are going to say if interest rates continue to go up, that the housing market's going to crash. Another counter opinion to that is what are people going to buy if they don't want bonds anymore? If they don't want bonds anymore, where's that money going to go to seek value? And where's a good spot for an inflation hedge? Homes have actually been a really good inflation hedge, especially if you have a loan against it, because it's very leveraged. So as we lose the bond market, money is going to seek alternative investments, hard assets, and housing is a hard asset. So as people think that interest rates are going to go up and that the affordability will go down, you're going to have people who have assets that have lots of money that are going to say, what am I going to do with this? I need to buy whatever the heck I can and get out of bonds. And maybe those interest rates will have a negative impact on the stock market. Remember the interconnectedness here? This is also part of the stock market. JP Morgan is essentially priced with stocks. So when this falls, people are going to say, I want to buy stuff that's hard assets. The problem is there isn't that much hard assets. There's a bunch of financial asset garbage. And that bunch of financial asset garbage is going to rotate into hard assets. And the problem is we haven't been at this type of bubble territory, which means they created a butt ton of money. That money went into financial assets, created these imbalances where we get these large financial stock valuations and even the bond valuations back a few years ago. And now all that money's got to rotate out and find an asset that has value. And I think where it's going to go, it's going to go into the real estate market. It's going to go into anything that it can buy that is a hard asset, in my opinion. Shanghai silver versus the COMEX silver. Remember, we already have a breakout. 3166 in Shanghai, 2850-ish in America or United States. That's going to continue to suck silver over to China. It's a gold rush to build AI data centers for Microsoft, Google, and Oracle. The number of new data center engineer jobs in Q1 was up 180% from last year for Google, 43% for Microsoft, and 578% for Oracle. All three had the most job openings for data center engineers ever in Q1. Now, here's the thing, guys. I don't think that's the best spot for investment. I think the best spot for investment would actually be copper because the transmission of electricity is going to shut down these data centers. Selling, so my brother actually he's part of selling the transmission business in electrical transmission. He sells the poles, he sells the lines, he sells all of those things. That's the best spot to be, not the data center. The data center is going to be basically constricted by electricity use. They're not going to have it. We need to build far more electricity generation and transmission lines. That's where the money's going to be made. That's the choke point, in my opinion. So here's Sahara silver at the flag breakout here. So if we look at this, we kind of zoom in, that it's right at resistance here that we're trying to break out still. We have a little bit last resistance, and then it's game on like Donkey Kong. And we could go up to very high levels for the price of silver. Very, very high levels. And that's silver priced in inflation. We're right at resistance there. German energy suicide in one chart. So bottoming at a level last seen during the deepest lockdown and great financial crisis. Let's celebrate. This is Germany's energy-intensive industrial sectors are bottoming out. And they basically screwed that sector by not having the electricity. That's what's going to happen to the data centers. The data centers are going to get choked from electricity. We just don't have to generate that amount of power for the data centers. So I think that the choke point's going to move upward into energy transmission and also electricity generation. And that's where the money's going to be made. It's going to be in energy. Sad to see this, or sad this chart had pink breakout, and now both gold and copper have broken out individually. Gold is a safe haven and copper a base metal that does well in good economic conditions, aka Dr. Copper. It is now as a new high after the pink double bottom test. So gold, in his opinion, is going to break out against copper. And we're to go into the inflationary 2020s of a big move potentially in gold. And again, remember the first chart I put up. Inflation is breaking that 40-year downtrend line. That is what is sparking all of this. Well, it's not sparking it, it's the deficits that are the root cause. The inflation and the yields breaking that 40-year downtrend is evidence of an inflation problem. So we've got evidence of chart patterns that are correlated across the board that are evidence of all of this occurring. And this is more evidence of a ratio of gold to copper that is going to break out. I want to hit this one here because I like his opinion and I think it is correct and it's the way that I view it as well. And I was surprised that someone said this the way that I would have said it. He says, energy cannot be created or destroyed. It can only be changed from one form to another. And then it says, hold my beer, Einstein, Bitcoin investor. So here's Kevin. He says, energy consumption and waste in Bitcoin mining, the entire life cycle of a Bitcoin mining operation is marked by substantial energy use, starting from the extraction and processing of raw materials for manufacturing mining hardware and constructing the mining facility. This initial phase already embeds a significant amount of energy into physical assets that are necessary for operation. Once the mining operation is set up, and begins, the bulk of energy consumption shifts to the operational phase, where electricity powers the intensive computational processes required for mining Bitcoin. A critical point here is that a considerable portion of this electrical energy is converted into waste heat due to the inherent inefficiency of electronic devices. Cooling systems, crucial for maintaining operational integrity and efficiency of the mining hardware, further contribute to energy consumption. Again, with a large portion of this energy ultimately transforming into waste heat. The tangible and intangible outcomes. At the end of this energy intensive process, what remains physically are depreciating assets, the mining facility, including the building, the computer equipment, and cooling systems. These assets represent a significant investment but lose value over time due to wear and tear, technological obsolescence, and the continuous need for energy to maintain operation. The intangible outcome of this process is the mined bitcoins themselves, a series of digital codes that intrinsically contain no actual energy or tangible value. The perceived value of Bitcoin is subject to market dynamics, essentially based on the principle of supply and demand. It relies on finding someone willing to exchange tangible assets or fiat currency for these digital tokens, attributing value to something that is inherently cost intensive to produce, yet lacks physical form or utility. Reflection on the process. This perspective emphasizes the stark contrast between the high energy input required for Bitcoin mining and the nature of the output. While the process secures the blockchain and validates transactions, providing a form of digital trust and security, the efficiency and sustainability of such an endeavor come into question, especially when considering the environmental impact and the eventual depreciation of physical assets involved. The value of Bitcoin then is not grounded in any physical embodiment of energy or tangible worth, but in the collective belief in its value and the willingness of individuals and markets to trade real world assets for these digitally mined tokens. This dynamic raises broader questions about the allocation of resources, environmental sustainability, and the evolving nature of value in a digital age. In conclusion, Bitcoin mining represents peak stupidity. It will come to be valued in time for what it actually is. Nothing but a complete waste of energy with no redeeming tangible value remaining. Ownership of Bitcoin is the mark of a Ponzi loving moron. I love it because everyone says, well, go read the white papers. Stupidity is what it is. That is what it is. And that is exactly why I am buying tangible physical assets. No one wants Bitcoin. They want what it can buy. They want the house, the big mansion that Bitcoin can buy. They want the Lamborghini that Bitcoin can buy. Nobody wants the actual digital code of Bitcoin. They want what it can buy. So what I would do is I would invest in what the things that people want, the physical things, because that is what has the value in the world. And I completely agree. It's a complete waste of energy and a complete waste of resources to mine Bitcoin, in my opinion. I love it, Kevin. I love it. Here's gold at the breakout here, and we are about to break out and run. Here's another thing. We've got these big cup and handles. This is a cup and handle breaking on gold. We've got the big cup and handle, the 45-year chart pattern on silver. Silver is the number 2 commodity in the world. Basically, it is a function of all these things that we use in the world to transmit electricity in, we'll call it integrated circuit boards and stuff like that. What I think they have done is that they created Bitcoin to soak up some of the liquidity in the system, perhaps. And it is a way to take money and absorb money in an intangible asset and of what they think is an asset. So it's a way to soak up some of the liquidity from people that don't know any better, in my opinion. But what's really occurring underneath is that the tangible assets are about to rip. And they're going to be left out when So when people are going to struggle in this world, they're going to sell their Bitcoin in order to survive or maintain their standard of living. I don't think people are going to run to it because it's a safe haven. I think gold and silver are going to be the things that are going to be safe havens because there's no way of stopping it. You can stop Bitcoin. You shut down the off ramps. You just shut the whole thing down. You can't stop a transaction from person to person outside of the system. That's way more difficult, in my opinion. How many years of running at double digit or running at double the inflation target is too much and forces the Fed or consumers to care? Second wave will probably last 2 years. We're going to be at 4 or 5% core annualized inflation for 6 or 7 years. Wouldn't say Powell seemed particularly alarmed yesterday. He doesn't care. You have to run that type of deficit in order for the system to survive. It's going to be inflationary. And again, it's all interconnected. Everything is. Because when rates fall even a little, housing demand will gobble up all the available inventory. I completely agree. Guys, we have a ton of demand. It's just not affordable to them. And if rates were to go down, it's game on for the affordability for them. Because if we ever get proper interest rate cutting cycle, there are going to be so many households with sub 40% LTV mortgages looking to cash out or trade up that there won't be nearly enough high-end homes or $50,000 plus trucks, SUVs to meet demand. Of course that's the case. It says the inverse correlation of gold and the US dollar can be strong shorter term, but longer term, it's not an issue. It said recently this chart's about to break out. It now has. So now also, this very important, very big picture chart shows that the next historical leg up for gold is here. Big, big move here. And yes, I would get very long in precious metals here, in all of them. He says, been consolidating for 12 years, should be time for another big breakout, looking at a similar red pattern inside the triangle, i.e. time for another long period when gold outperforms the USD. Now got the big breakout already. So here we go. Investment wisdom, confusing the price, so the stock price, with the story is the biggest mistake an investor can make. And what he says here, it causes people to bail out of stocks during crashes and corrections when the prices are at their lowest. So don't confuse price and a story. You have to disconnect the price from the business. The stock price is not the same thing as the business value. The business value and the stock price and the disconnect between those two things is the very thing we are looking at for investment. We want to see a value disconnect. And Peter Lynch knows that. Warren Buffett knows that. Everyone who makes a lot of money in the stock market knows that. The people who emotionally trade, what he's describing here is emotional trading. Confusing the price with the story is the biggest mistake an investor can make. You want to value the business, and then what you want is you want a crash or correction where the price gets the most disconnected from the value of the business. And that's where we take our technical analysis and our ratios, and it'll tell us when we're low. And we buy those companies when they are out of favor. Out of favor is causing the value disconnect in the stock market. And that is where I'm going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys like. That's exactly how I invest. I look for the value disconnect, and I use the 3 pillars: ratios, market conditions, and technical analysis. Market conditions are a lot that we just went over today. The market conditions are increasing interest rate environment, breakout on gold. That's technical analysis that we're using. Breakout on silver. The deficits, market conditions. Big deficits, big inflation. All of those things are interconnected. So what's the best value in the market today? What are they? Where should I be putting investment money? That's exactly what I do is I find those technical analysis setups that have good value, good ratios. It could be Elliott wave sprinkled in at a bottom of wave 2. Buy it, hold on, because the value of the business is growing and it's inflecting positive to greater and greater earnings in this big inflationary environment, which is the tailwind behind the investments, and it's all interconnected. it's not too bad there. So that's what I do. That's exactly what I do, and I sit in these things and just wait. And I've been doing that since 2020 with very good entry points and energy, and which is a very inflation sensitive asset. There's a reason I chose these assets because it's inflation sensitive, because interest rates are going up, because inflation from the deficit spending, it's all interconnected, guys. But that's what I've got for today. We've got a question and answer session coming up on Sunday, 5 p.m. Mountain Standard Time, and we'll see you guys there.